Welcome to Explainer. Okay, let's dive into this, because today we are completely tearing down pretty much everything you thought you knew about money. We're looking at the true cost of credit. If you have a bank account, a mortgage, or honestly, if you've ever just bought a coffee with a debit card, what we're about to uncover affects absolutely every single aspect of your daily life.
So let me start by asking you a seemingly simple question. Who actually creates the money in our economy? Now, I want you to be totally honest with your first instinct. Most of us imagine it's got to be incredibly complicated, right? Our brains naturally kind of hate the real answer, mostly because we just assume banking has to involve giant steel vaults, heavy stacks of gold bars, and, very serious men in expensive suits nodding at complex spreadsheets.
But just look at this comparison. When researchers ask everyday people this question, almost everyone answers the government, the central bank, or the treasury. And hey, that makes sense. That is the exact illusion we all grew up with. But here is the totally jarring reality. Private commercial banks create the overwhelming majority of our money, and they do it entirely out of thin air. Not the government, your local commercial bank.
Section 1. The Banking Illusion and the 2014 Discovery. Let's head over to a small German bank where a massive myth was about to be officially busted.
To really understand how this is even possible, we've got to look back to 2014. An economics professor named Richard Werner spent months convincing a small, totally unassuming commercial bank in Germany to let him observe something absolutely unprecedented, a real loan being approved from the inside. Months later, they finally agreed. They opened their books, opened their systems, and in that exact moment, Werner watched bankers step by step create brand new money out of absolutely nothing. He became the first person in history to document bankers literally typing new money into existence. And just to prove this isn't some wild internet conspiracy theory, shortly after, the Bank of England officially confirmed this exact process in their own official publications. No way, right?
Well, this completely shatters the traditional textbook story we were all taught in school. You know the one. You deposit your hard-earned money, the bank keeps some safely tucked away, and then lends out the rest. If that were actually true, the bank would literally have to open up someone's account and say, "Sorry, Linda, we're temporarily borrowing your pension so Jason can finance a jet ski in a midlife crisis." Nope, that is hilariously false. They don't touch Linda's money at all.
Section 2. 3 types of money. Because to truly understand credit, we first have to understand that not all money is created equal.
And this brilliantly illustrates how our money supply is actually broken down. See that tiny, almost invisible sliver? That is physical cash. A slightly larger slice represents central bank reserves. But that massive majority taking up almost the entire picture? That is commercial bank digital money.
Let's break these 3 down real quick. Central bank reserves are basically like an exclusive VIP lounge. Normal people never see this money. Banks just use it to settle payments with each other. Then there's cash, the physical notes and coins. Like that $14 permanently living in your car's cup holder. But the giant piece of the pie is commercial bank money. This is your salary, your mortgage, and that digital emergency fund that somehow magically became a holiday fund. It's all digital, and it is entirely created by commercial banks.
Section 3. Creating money from nothing. Let's utterly destroy the myth that banks desperately need your deposits to lend. Think about this logically for a second. If banks genuinely needed your deposits in order to lend out money, they would be desperate for your cash. They'd be throwing 12% interest rates at you, free holidays, free smartphones, literally anything to get your money. Instead, they offer savings rates that inflation finds genuinely hilarious. Why? Because deposits are not the thing limiting lending. So if they don't need your savings to hand out a loan, where does the loan money actually come from? If someone asks for a $20,000 loan, where does that exact physical money originate from? Nowhere. The short answer is literally nowhere. That money genuinely did not exist seconds before the loan was approved. No vault was magically opened up. No cash was moved from a dusty back room. It all comes down to double-entry bookkeeping. I know, it sounds like the most insultingly boring accounting method on earth, mostly because it is. But this boring method silently runs the entire modern financial system. This is the actual, literal mechanism of money creation. Here is exactly how the magic trick works in 2 steps. Step 1, the bank records an asset on their balance sheet saying, "You owe us $20,000. Then simultaneously, step 2, they record a liability saying, "We owe you a $20,000 deposit in your account." 1 entry on the left, 1 entry on the right. Both increased by 20 grand. And just like that, the act of typing those accounting entries was the act of creating the money. You didn't need to open a single vault. And if you're wondering about reserve requirements, holding money back just in case, in many countries today, those requirements are essentially zero.
Section 4. The mathematics of credit. Let's see what happens after the money is created.
Now that you've accepted this weird new reality, that the bank literally typed your money into existence and you happily took it and spent it on a ridiculously fancy espresso machine that now aggressively judges you every morning, let's explore what happens next. Here is the secret life of that loan. A loan is really just two things, the principal and the interest. We're in a trench coat pretending to be one thing. Money gets typed into existence, you buy your judging espresso machine, and then you start paying the loan back month by month. But here is the wild part. As you repay, the principal doesn't go back into a bank vault. It is permanently deleted from the economy. The exact same keyboard that created the money effectively destroys the principal upon repayment. Just gone. Deleted.
But something stays behind. If you borrowed $20,000, you might repay another $4,000 in interest over the life of that loan. The principal appeared, and then the principal disappeared. The only thing left behind in the economy is that $4,000. That interest is the true, lasting cost of the credit cycle.
Section 5. Why housing prices skyrocket. Let's move to and see how this builds from micro-level loans to macro-level economic impacts.
Remember, banks can't just create absolutely unlimited money. They still need borrowers who can actually repay, and they need to firmly believe they'll make a return. This means they get to choose who gets the newly created money first. Imagine you are running the bank. Person A asks for $80,000 to open a restaurant. Well, that's a terrifying risk. Restaurants often just turn into empty buildings with faded motivational quotes painted on the walls. But person B asks for a $700,000 mortgage. If they stop paying, you simply take the physical house. It's safe, it's backed by a real asset. Who are you going to lend to? Exactly. Banks overwhelmingly prefer lending to existing physical assets.
And when you connect the dots, everything clicks. Banks direct massive amounts of brand new money straight toward property. Every single mortgage approval creates massive new purchasing power out of thin air. But the number of houses isn't magically multiplying, so you have more and more money chasing the exact same amount of houses. The result? Higher prices. When this repeats millions of times over decades, house prices don't just rise, they accelerate. Housing affordability isn't just some local real estate issue, right? It is a direct symptom of how bank credit flows.
Section 6. The true cost of credit. Time to zoom out and look at the human cost behind all this jargon.
Think about your daily grind for a second. Every single early alarm clock. Every soul-crushing daily commute in terrible traffic. The exhausting overtime shifts. Those endless Monday meetings that absolutely 100% could have been an email. Beneath all the complex economics, we are literally trading pieces of our finite, precious lives for this money. Money that a bank simply typed into existence.
So, the crucial point is this. Money is your labor frozen in digital form. Hours of your actual life are converted into numbers on a screen. Understanding money isn't just about understanding high finance. It's about understanding the exchange rate between your life, your time, and the world around you. Honestly, this totally reframes how you should think about your paycheck moving forward.
Which leaves us with one final, very provocative question to ponder. If you don't understand money, who is writing the rules for your life? The financial system dictates the house you can afford, the business you can start, the risks you can take, and ultimately, the freedom you have. Understanding the system doesn't magically fix it overnight for sure, but it does do something incredibly important. It means you stop playing a game without knowing the rules. And learning the rules is exactly where winning starts. Thank you so much for joining me in this explainer. Keep questioning, keep learning, and I will see you next time.